Hey everyone, welcome back to the channel. Today we're going to take a quick look at Wish. To be honest, this wasn't a company I was super familiar with, but figured we could poke around it a little bit together and kind of see what we could come up with here for evaluation. So I pulled income statement and then some kind of key stats off their S1 filing. I'll show you quickly where to get that if you're new and never done anything like this before. Head on over to sec.gov, more search options. And then I believe their ticker symbol was just Wish. And then you can come here and you can find their S1. And then, the S1's a great document. Every company that IPOs files one, a lot of different stuff in here. Pretty long document that an investment bank will throw together. All sorts of, you could kind of go through here and read everything, but as you kind of filter through, they do provide some kind of financial information, different things. So I've pulled out in there what I thought was some useful information. So some revenue, and then some just like key stats that they had listed. So monthly active users, you can kind of see how that's growing. LTM active buyers, and then adjusted EBITDA, and then they provide a free cash flow. They kind of have a reconciliation to it, but not really. They do cash provided by operating activities. And they do reconcile to cash provided by operating activities, but you can see it's a lot of different things here. Reconciling here to get to that aspect of it. But so anyways, before we get too far off track, I've linked up the historicals. We'll have to pro forma 2020, and then from there forecast out 2021 through 2030. Usually what I do, they provide us 9 months ended for 2020. I'm going to take the 2019 amount of 9 months ended, see how much that was of the total year, and then take that percentage, and you can take that and turn that into the full year 2020. So the formula here, and actually I typed it out up above just to make it simple. So you do 9 months ended, which is this, divided by the percentage, which is here, and then we should just be able to subtract out this. And clearly I did not do that right. Thought I typed out the right thing here. Let me see here. It would help if instead of 2019, I did 2020. And then, so this should get us the incremental portion. So then what we actually want to do here, I actually think we don't want to subtract that. I think we want to add that. Nope. Hang in with me for just a second. Now let's add the 9 months ended. Now you get 2506. And that'll tie to the 69%. Okay, so typed out the formula and stopped halfway through and then had to think through it real quick. So you take 2020 9 months ended divided by the 19%. You're going to subtract out this amount here, and then I guess that's actually just like netting. So you just divide it really. So that's the formula. Way simpler than I thought. Anyways, copy that down real quick. Copy over the formula here. And obviously this isn't going to be perfect by any means. This is still just really an estimate. So we'll see how this looks, see if they're getting more or less profitable, determine if we think things need to be tweaked at all, which I'm guessing they do, but we'll see here in a minute. Interest expense, it's at 0. This is negative 55. I'm just going to link that up. Copy that over. And then we're just going to put 0. I'm guessing they're not turning a profit. And then we'll get a net loss. And you'll see, so I think the big issue here is we held SG&A or sales and marketing like at that same percentage, and I don't know if that's necessarily fair. I think we've seen product development and G&A increasing, but on the sales and marketing front, we've actually been seeing a decrease. Um, so I'm actually gonna, let's see, if we hold it there, you know, and I guess we'll dive more into it actually on the DCF tab. I guess kind of understanding how this is trending and if they're able to kind of get these costs back in line. So I mean, they saw a decrease here. Now we're going to say an increase. So we'll actually, let me just take this and so, I mean, I don't even know if this is linked up yet on the other page, but this way it's still decreasing. They're still unprofitable, but it's not as bad per se. But now if we come back to the DCF tab, you'll see here it all kind of flows through. Depreciation as a percent of CapEx. Depreciation amount. So CapEx amount, I guess here, that's another thing we're gonna have to forecast. You can see their CapEx is actually pretty low. So this is 2020, which makes sense. I mean, they're a phone application to buy and sell stuff. So I'm just gonna set this equal here, and then let me come back to my DCF, see if some of this stuff starts flowing through. And then here, we'll set this to the 90%, and we'll calculate this as we'll multiply it out. But I mean, this is pretty immaterial to their overall fluctuations there. The big drivers here is really their working capital, and the way they provide it is actually, they just provide change in operating assets and liabilities, and you'll see the big line items here. Merchant payable historically was really big, and now you're seeing accrued and refund liabilities. This is really just bad debt, I would say. I mean, it's how I would think of it. Obviously, refund liabilities is if something gets sold and then they're on the hook for the refund if the original seller isn't fulfilling their obligation. Merchant payable, looks like they did a really good job of extending their terms, pay the merchants later, and then they've been done a good job at, looks like their funds receivable has been decreasing. So, but it looks like overall it's kind of coming closer to having less of an impact, 268, 113, and then here it's 48. So it's slowly kind of coming down. So that's something that, we'll have to forecast here. And honestly, I don't like using change in working capital to be a big driver of free cash flow. That's never a good sign for a company if that's how you're driving your cash flow, is based off extending payment terms. So we'll see. But I guess for revenue here, this is kind of the big thing that we need to really wrap our heads around. So we see the user growth, right? And if we were to look at kind of the revenue per user, we could do that and you could see how it's trending over time. They've definitely increased it, but then in this kind of last round here, it's decreased. So maybe it kind of hovers around, let me just label this. This would be revenue per MAU. So if we think they're MAUs, and look, we can look at the growth here, right? We can just see how active users have been, wrong button, active users have been growing here. The growth is coming down. The question is, are they going to be able to sustain kind of this high growth of users? Let's say, I mean, I guess we technically have a projection here, and we can back into how many users we think that would be. So this is what we're forecasting. If we think they hold that constant, right, then we can come in here. We can try to project out how we think their user growth is growing, right? So 30%. Now, if you tweak this, right, you say, oh, they're kind of increasing that. However, that's trending, right? That's gonna impact everything, or if you say actually this is decreasing, then maybe user growth is back in the 40% range. So the big thing here is how many monthly active users are they going to have? Are they going to be able to continue to monetize them? And are they going to be able to keep kind of this crazy sales growth? So I guess our first analysis here is we're going to hold it high for a couple of years, and then we're going to decrease it. And I think that's probably fair, and then they'll become kind of like a mid-single digit growth company once they've matured. We'll leave something like that, and we'll see. These things are always a what if kind of scenario and wrapping your head around. And obviously, right, we could come back in here and calculate how many monthly average users this would be at their current monetization rate per user and see if those numbers make sense. So we'll take a look at that. COGS shot up drastically. Is that correct for 2020? That seems wrong. That's probably most likely wrong. What did we do wrong here? What's the percent there? 34% versus 19%. No, their costs have just shot up. That's crazy. That seems bonkers. So we're gonna put them at 30% and just see how that goes. And maybe actually even just like decrease that. I'm not sure what's causing that crazy cost to go up. We'll see if we can't get them back down to around 20, and then at 20 we'll hold it constant. So we'll do that. SG&A, I think this is the big thing, right? Like their SG&A was growing like crazy, right? 100% of sales, but it finally started to taper. So maybe instead of, I guess we'll hold it as a percent still, but maybe we'll hold it to the 60% for now and just see how that kind of looks when we scale out the whole thing. Their CapEx is just so immaterial. I'm just gonna hold that flat. And we'll see what this gives us, what kind of revenue and the user growth, as I was saying, and see if that's actually even possible. We're going to hold this. The idea here is depreciation should never be 100% if you have growth CapEx. It should be less than 100% because that shows that you have growth CapEx on top. And then the D&A amount, this will actually just be a calculated field. So let me do that. This will actually be a calculated field now as well. If we come up here and times it by revenue. So we'll do that, see what kind of things we get. And then the last part will be working capital. Honestly, I'm inclined to keep this close to zero. Not a big fan of having big working capital swings to be the driver of if your company is going to succeed or not, or be valued. So we'll see here, 1 plus growth rate. So we're going to see, that makes it 11 billion in sales in 10 years. And we'll back into, we'll just create a line down here. We'll call it implied MAUs. So right now our MAU rate, if we come back here, was 21.22. And then we can take revenue and divide that here. Make this, oh, we gotta lock the cell. It's not K4 that I want to lock. It is, of course, F4. There we go. So now we can kind of take a look at this and we'll see how off, if we hold this rate constant, so 81, 90, and 118, so 73, 90, 125. So I mean, it's all relatively close in the same ballpark. But the question is, are they really going to get 500 million users on a mobile app? Basically Craigslist? No, they're not. So this is going to have to increase over time, for sure. If we believe this, they're going to have to start having more revenue per user. But for now, that's fine. And we can come back and tweak some of that COGS as a percent of SG&A. Copy those formulas across. SG&A as a percent of revenue. This I think has been what's made them unprofitable in the past, and it looks, things start to look better going forward if they can actually maintain it at closer to the 60%. DNA, this number is just like, what's going on? Oh, this is a negative. So I'll just link it up negative. Right now, it doesn't look like they have a lot of CapEx. As long as they just stay as this kind of single item mobile app, probably won't have a bunch there. Tax rate, I think we're just using 21%, which is the corporate rate. And then CapEx here links up. So you can start to see a little bit more profitability down the line based off these assumptions. If we come over here, we can kind of, I always do 10% expected return. This is actually formatted wrong. It's one too many decimal places. But you can see we're probably gonna be pretty far off from their valuation, but we'll see. Maybe we're not too far off. Some of these don't have the same formatting. So we'll set that up real quick. Give us an equity value, 14.5 billion. They probably have net debt. Honestly, I don't know if they provide they probably do provide debt numbers somewhere. I'm gonna guess it's pretty small since they IPO'd. They might have some warrants or something of that nature that's gonna convert to stock at some point, or some sort of bridge financing that's gonna convert to equity from VCs. But roughly 14.5 billion. Let's pull up Yahoo Finance here and see where they're valued. I honestly don't know. I didn't know much about this company. Someone recommended I look into it. Figured it'd be an interesting thing to just kind of look at. That's NVIDIA. I thought I typed in Wish. I was like, wait a second, this is a $300 billion company. We're doing something really wrong. 14 billion. Okay, so we're basically spot on with those assumptions. Let me change the sensitivity table as well. So we can see kind of depending on your required rate of return, if you only need an 8% return, you'd pay up to 21 billion for this at a 3% indefinite growth. So I guess the question really is, when we look at this, are the monthly active users going to grow at these rates? Probably not, and they're probably not going to hit 550 billion users. So then it's going to come into, if they were getting 25 a user, right? Or if you think long term they could get 30 a user. 50 a user, then you need 200 million people on the platform. So you can really kind of see, and right now they've hovered historically around, lower than 20 for a long time, and they got into the mid 20s. So maybe they can scale it up to 30. That would imply almost 400 million users on the platform. That's a lot. And if you think maybe they're not going to grow so rapidly anymore, we're going to give them 25%, and then it's going to slowly decrease, and then they're going to hover off at 5, hold that flat. You're still not too far from the valuation there. If you only required an 8% return, you're there. But even at that rate, how many, and if we go back to their current value of about 22 a customer, you're still anticipating them to eventually have 350 million users. Maybe that's not too far off. If we look at like How many does Facebook have? 2.7 billion. Okay, so that's a lot, but they're also the largest social network. How many does Craigslist have? I don't even, they may not actually even, 100 million, 60 million users. Okay, eBay, 167. Do I really think Wish is going to surpass? Honestly, I'd never even heard of Wish. I think everyone's heard of eBay. Um, I mean, I don't know if Amazon would report this or if this is something like how many active users they have. I don't know. 197 million people visit each month. That seems low. So I don't know. Hard to tell. But I mean, right now they're at 90 million, probably pushing 100 million. But is that where it plateaus and then this really becomes a story of selling more to their user base? I don't know. Um, I guess that's for you to decide if you're actually looking to make an investment in this is how convinced are you in their ability to continue to grow their user base and then to continue to change the monetization per user. And obviously the more sellers they get on the platform, the more users will come. Um, but yeah, I mean, just kind of looking at it at first glance, I wouldn't say it's like overly overpriced. Um, is it aggressive? Sure. Um, but I mean, it looks like what they IPO'd at 23. What's it have in here? What was the valuation at the IPO? Sometimes is there an amended? Usually they'll file like an amended one. Maybe this will have it. Nope. It's S8. I don't know. I should know what these are. I had to pass a bunch of regulatory exams. 24. No, that's equity incentive. The 8K, this is probably saying they're going to release quarterly earnings. Nope. Corporate director. So an 8K is just material information. Oh, maybe the prospectus. Let's see here. Here we go. So yeah, they IPO'd at 24. Um, which, you know, at 24 a share, you're valuing them, it's what, 20% increase from current valuation roughly, so $17.5 billion company. So pretty rosy valuation. I mean, you got to really believe that they're going to continue this growth and then they're going to be able to cut SG&A. It'll be an interesting story to see play out, but yeah, it was an interesting one to look at. Would recommend reading through the S1. It was pretty interesting and something that I had never looked into. I'd never even heard of the platform. And then when I start searching it, ContextLogic comes up. Apparently that's the legal name, but they go by Wish. So I hope you found this useful. If you have any questions, let me know.